I guess in answering the question, what have we learned in 2016? I think you've got to remind yourself that markets are one long, enduring learning curve. You're never done learning. And I think if a fund manager thinks he's done learning, he's finished, because the market loves to humble. And I think 2016 has been a humbling year for a lot of managers. I know that one or two of our peer group have said exactly the same that I'm going to say. This has been the toughest year I've known, 2016. And I guess one of the things that's made it particularly tough has been the rotation. And somebody said it has been a trader's market. But the rotation has been violent. And it's been violent because of positioning. The big lesson I learned in 2016 was maybe you didn't look at positioning enough. And we always try to look at positioning. But I think positioning, first you had the rally in energy, then you had the rally in mining, two areas that people had found for a number of years very easy to avoid. And going into the close of the year, what I would call the big one. And thankfully this one we did manage to be on the right side of. Unusually for us, liking the banks sector, very unusual, but we managed to get pre-positioned for that. And that was applying the lesson we learned about positioning. I think that the key aspect, key influences on markets going into 2017, on equities, will be whether I'm right or not in my view that we're moving globally from a growth to a value market. It's been a one-way growth market since the crisis. You haven't wanted to be in value. I'm not a great fan of those labels, growth versus value. I tend to sort of think these things are in the eye of the beholder. But I do think that we are running out a road, and I think this will shape markets. We're running out a road on QE. Central bankers know this. I therefore believe that we have touched the lows on bond yields globally. And therefore, I think we've touched the highs, the high watermark on valuations and the outperformance of so-called bond proxies, but stocks that are also comfortable to be in. I think, as you saw in the month of October, November, the months of October, November, it became very uncomfortable to be in some of those things. I think that's only just begun. Now, to be right on that, I've got to be right on one thing, that deflation doesn't win, and that bond yields have therefore further to go up, or certainly are not going down. If deflation wins and bond yields go further down, that view is wrong. You don't want to be in value. You want to be in so-called quality growth. I happen to think that view is not wrong, and you don't want to be in quality growth. That was the last decade. I don't think it's the next decade. The highest conviction positions moving into 2017 are not that high conviction. I think if you have high conviction at the end of 2016, you're a strange person. Or you've got a stronger constitution than I've got. I've always actually said, beware of the fund manager who has high conviction on everything at all times. That's actually quite a dangerous beast in my view. I think a dose of humility and neurosis is always welcome. And so I go into 2017 shaken by some of the events of 2016, the rotation, etc. But where I do have conviction, it is in the view that we're moving from a growth to a value market. And one of the reasons I don't want to say I've got high conviction is not just the events of 2016 and just how tough it's been for active managers. It's actually that my biggest sector as we move into 2017 is something I have not liked for the past decade. It's financials. What to expect from our asset class, our portfolios going forward. There's a whole interplay of things to answer that. I think currency is important. I think if we get a strong dollar, it's usually good for European equities. It's usually less good for emerging market equities. And if I'm right that we're moving from a growth to a value market, I think this can knock on the head US equity outperformance versus other parts of the world. The value markets of the world are more Europe and Japan, actually, than they are the US, just by the nature of the indices. So I think there might be an asset allocation shift to come. The thing that holds me back in getting high conviction on that actually is the political upheavals that we've seen. Brexit, Trump, are moving now to Europe, and that's going to be a whole lot trickier. It's not one nation. It's this currency bloc. And I think you could easily see the wobbles come back on the periphery, the euro, and that holds me back from saying, actually relative to the US, Europe is now a buy. It just holds me back a bit because I am a bit worried about the political risk. We will get through that political risk. And actually that's what might create the opportunity to buy Europe. Europe has seen big outflows. European equities have seen big outflows this last year. This gives me much more optimism. I went into 2016 not a bull. I end 2016 more bullish.